Morning students, today we discuss about 11th accountancy morning video. In this morning video, we continue the same chapter, that is conceptual framework of accounting. So in this chapter, we all discuss about various meaning, definitions and importance of business accounting concept, and also some of the advantages and disadvantages, and some basic concept, accounting basic concept. We continue the same accounting basic concept. Seventh point, matching concept. So in this matching concept, according to this concept, revenue during an accounting period are matched with the expenses incurred during that period to earn the revenue during that period. That is, in this matching concept, revenue should be matched with expenses. So during that accounting period, whatever the revenue will be collected in the business, that should be taken, and whatever the expenses spent in order to maintain the business, that also should be taken, and both the revenue and expenses should be matched, and final result, whether profit or loss, will be considered by way of matching the two items. So this concept is based on accrual concept and periodicity concept. So periodicity concept fixes the time frame in measuring performance and determining financial status. So all expenses paid during the period are not considered, but only the expenses valued to it accounting period are considered. So 1 year accounting period expenses should be taken. Not all the expenses are taken, only the expenses related to the current year should be taken. On the basis of this concept, adjustments are made for outstanding and prepaid expenses, accrued and unearned revenue also should be taken, and due provisions are made for depreciation of fixed asset, bad debts provisions, etc. related to the accounting period should also be included. So thus matches the revenue earned during an accounting period with the expenses incurred during that period to earn the revenue before sharing any profit or a loss. Next, realization concept. So according to this realization concept, any change in the value of an asset is to be recorded only when the business realizes it. Then assets are recorded at historical value. Any change in value is to be accounted only when it realizes. So with the help of the realization concept, all assets are to be realized. The value, any change in the value of the asset based upon the opening value, that the changes should be taken to the account. So based upon the historical concept, the assets are to be valued. Next, objective evidence concept. Objective evidence concept requires that all accounting transactions recorded should be based on objective evidence. The objective evidence include documentary evidence like cash receipts, invoices, etc. So all the documentary evidence are to be considered in order to maintain the accounts in bookkeeping. So based upon the objective evidence concept, all the transactions should accompany with evidence. Whether it may be a receipt transaction or payment transaction, it should be have evidence in order to record the transaction in the books of accounts. It ensures authenticity, accuracy and reliability of transactions entered in the books of accounts. Then accrual concept. According to this accrual concept, the effect of transaction are recognized on mercantile basis. when they occur and not when cash is paid or received. So the transaction should be whether paid or received, or whether accrued or outstanding. That also should be taken on the basis of accrual concept. That is, when they occur and not when cash is paid or received, it should be taken for accounting. Revenue is recognized when it is earned, and expenses are recognized when they are incurred. So all expenses or revenues related to the accounting period are to be considered respective of the fact whether revenues are received in cash or not, and whether expenses are paid in cash or not should be taken. Next, convention of consistency. The consistency convention implies that the accounting policies must be followed consistently from one accounting period to another. That is, all the accounting systems should be followed regularly throughout the life of the business. The accounting system should not be changed accordingly. So the accounting record should be a consistent one year after year. The result of different years will be comparable when same accounting policies are followed from year to year. Then only we should analyze the growth of the business, and we should compare the business with the other business, not to consider the position of the business. Next, convention of full disclosure. It implies that the accounts must be prepared honestly, and all materials information should be disclosed in the accounting statement. So this is important because the management is different from the owner in most of the organization. So full disclosure concept should be strictly followed. So what are the material aspect related to the informations, transactions, that should be given to the management for further reference. So accounting statement should be a full disclosure concept. No secret profit should be taken, or false transactions should not be recorded in the books of accounts. Next, convention of materiality. According to this convention, finance statement should disclose all materialistic which might influence the decision of the users of financial statements. Hence, any item which is significant and is not relevant to the user need not be disclosed in the financial statements. So all the informations in the business should be a materiality one, and all the relevant fact should be disclosed to the management for any changes happening in the transactions. And this principle is basically an exemption to the full disclosure principle. The term materials is subjective in nature. So materiality depends on the amount involved in the transaction, size of the business, nature of information, requirement of persons making decision, etc. These are the materiality one for the business, not to record all the transactions. Convention of conservatism or prudence principle. So it is a policy of caution or playing safe while recording the business transactions. One has to anticipate no income but to provide for all possible losses. So every business people, based upon this principle, they should be very cautious in recording the transaction, in running the business. They should be considered all possible losses. They should not consider to be an income. So that is the main principle should be followed in the business in order to run the business successfully. And accounting standards, that is need for accounting standards. There are some points related to how we should need the accounting standards to promote better understanding of financial statement, to help accountant to follow uniform procedures and practices, to facilitate meaningful comparison of financial statement of two or more entities, to enhance reliability of financial statements, to meet the legal requirements effectively. So for these purposes, the accounting standard should be the same almost all the business people, and also in every year they should not change the accounting standards. They should follow the same system of accounting throughout the life of the business in order to need some important points about the accounting information. So with that we conclude this video. We can start a new chapter in next video. Thank you.